Today's number is 0.04 because what we just saw happen to markets is incredibly rare, and it has many people calling that we may be heading into what we call stagflation, one of the worst economies that you can get into. But is that really what Jerome Powell was saying when he delivered a 25 basis point cut? Well, one thing's for sure, he did say there were some potential trying times ahead, and it had markets starting to get very volatile. So in today's video, we'll break down what exactly just happened, why everyone's trying to hedge the US dollar right now, and whether construction looks like it's falling off a cliff. There's a couple of big problems, but as always, there could be a silver lining. Join us as we cover stocks, commodities, and cryptos as we break down what you need to know right now about markets around the world. See you in a sec, guys. This one is not to be missed. Well, welcome back everybody to The Daily Show. My name's Thomas Atkinson, and in today's video, we have a lot to discuss because it was down with some of the big tech and up with everything else as the Federal Reserve delivered its first rate cut in quite a while. Now, why is this important? Well, it had a little bit to do with actually the dot plot, and we'll take a look at that in a moment, but it seems to be sugar rushing the market, at least for now. Is it going to be just a trajectory to the sun? Well, we've got some overlays that we can use, and there are some similarities still happening here to one of our favorite reads, which is from the 1990s. So it was dot plot release up, then it was something about AI causing issues with the job growth from Powell down, and then it was back up as he made that a more positive tone. This was sure to be a volatile session. The next 24 to 48 hours may be as well because, of course, we have options expiration, more on that later. But it was one of those times where you had to look probably at some of the numbers more than anything else. And the first one was Stephen Mirren, which is, of course, a Trump appointee to the Fed. Now, I believe he was the only one that dissented when it came to a 25 basis point cut, and he was looking for 50 basis points. But according to the overall dot plot, you can kind of see here he's angling for quite a few rate cuts next year. And this will have the market salivating at least about the short term gains in markets, particularly the chances of way more cuts on the horizon. Already we're seeing priced in another 2 cuts for this year, particularly in October and then possibly in December. And then we're seeing another 4 cuts getting priced in by next year. Could it be even more though? And could this cause us to go into stagflation, which is of course where we have low or no growth and we have inflation potentially caused by tariffs and other things. Well, of course, that's the concern always in markets, and there always is a concern. You can see here, according to the latest report here from Goldman Sachs, they really were mentioning a couple of things in the report. First up, it did seem like there were a couple of noted risks. Downside risks to employment have risen, even as inflation has moved up, kind of signaling that we may be going into that stagflationary economy. And I did notice that Jerome Powell said this was a strange thing and that these types of things don't usually happen and go hand in hand and all sorts of other problems. So it's basically expecting now that we're going to get quite a few cuts. And of course, the story will all be about really that change of the Fed next year. And that's going to be a huge point, especially if we get tons of cuts around that period of time. So will it be all green, all good for now? Well, let's have a look at a couple of things in the economy. And first up, there are some problems. Number one, job openings are declining at a serious rate right now. And you can kind of see here, it has been for quite a while. All the way through 2024 into 25, we've basically seen a weakening jobs market. This is driven by companies that overhired during this spike over here from 2021 to 22, saying, you know what, we don't need this many staff. And of course, the advent of AI replacing so many of our jobs. But it was actually a story maybe even weaker than that when you take a look at it. And it has to do with housing construction. Now, remember, recently on this channel, we've talked about jolts and, of course, the concerns there in the economy. Now, this is the macro side, and we need to remember that the economy and the stock market will be different things. Stocks care about profits and instant gains, and the economy cares about realistically a broadening prosperity and, of course, everyone being employed. Well, it turns out total housing construction in the US is declining at a pretty rapid rate. And you may notice that this happens at semi-concerning times when you go back through some of the recessions. In fact, it is one of those kind of, I would call, lead indicators, although it takes a long time to show up. You'll also notice here that when we look at total building permits, they're dropping off a cliff, and construction employment has only just started to really turn it around. And this kind of reminds us a little bit of when we go back into the 1980s and 90s, and we see here that we had total building permits falling off a cliff, while we also had residential construction employment starting to fall. And this actually did coincide with some problems in the property markets. Of course, the US got through it thanks to basically immigration and also innovation at the time, and many other factors. But there is a clear slowdown here in the building sector. And I'm sure most of you guys are already aware of this, and it's not big news, but it's the acceleration of the slowdown that we'll need to be looking at over the next 3, 6, and even 12 months. So what does this mean now for the cut? Is it enough to create a sugar rush? Well, one of the things here from JP Morgan actually shows that when we get cuts, and we've shown a statistic similar to this at all-time highs or within 1% of all-time highs, it doesn't tend to be that bad for markets. In fact, it does sugar rush markets sometimes. And the one I want to focus on here is the narrative that we've talked about many times, the 1998 to 2000 dot-com boom. Now, we all know what happened there. We got a couple of rate cuts near all-time highs, and we ended up finding a massive bubble. Now, you'll notice that when this came through, there was still more to be gained in markets. And it suggests, of course, that people will pile in and you may not get maybe pullbacks. But that's actually not necessarily true. In fact, during those periods of time, we actually saw very volatile markets with huge spikes and drops and all sorts of opportunity. So if you're just coming into markets right now, it actually might be that subscribing to this channel or any other channel really about financials is going to be one of the big things you want to be doing, because volatility is likely to stay and it is likely to get pretty wild. Notice some of these drops. They may not look like much, but actually these drops are quite significant and they're bought fairly aggressively. And this has to do with, of course, what happens when we get these types of very deep kind of pullbacks that are then bought up on euphoria, and then they're supported by policies. So of course, we've got tax cut policies, we've got AI making literally companies be able to say, hey, we need less staff, one of the biggest costs for most companies. And then on top of that, we also have this innovation concept where everyone wants to buy AI, because we can all see it's the future. The question is, which companies are going to be the winners? And also, when does it get too expensive? Do you want to be left holding the bag? But no one cares when you're entering into a bubble. And remember, when people say it's a bubble, guys, it's generally not over. You need that euphoria to come through, because people in 1998, as you'll notice here, did also say it was a bubble, but then they all went crazy. And some of the biggest bears went bust right around here when they were trying to short it. So it's something we're looking for, tracking it very closely. I'm sure a lot of you guys are. So why is this important? Well, around this point, we did see a slowdown in the 1990s kind of narrative, and we did see lots of dip pullbacks, which a lot of you might be excited for, because of course it suggests that there could be some really good opportunities on the horizon. Now, some of the ones that were more, negative after the V shape, well, they went kind of bad. But I think it's not just going to be in this. It's going to be in how does the market perform after these cuts? And do we see the rise of small caps and they break out? RK making a new high, which we'll look at later on. And of course, the Dow also performing a little bit better over the last 24 hours with a eventual recovery in the NASDAQ and S&P after that initial sell that did occur. So why is this all very important? Well, we're heading into that first stage of potential, at least for now, euphoria. And do remember, we've been talking about how we expected rotation back in July, August. We've gotten a lot of that. It started to come through. Now we're back to leading here a little bit in some of the tech, but we've actually entered a reading that is so incredibly rare, and it all has to do with euphoria. In fact, it seems here that the reading has only been above 85%. This is, of course, an extreme overbought, 0.04% of all trading days in the NASDAQ's history. So this is a super rare reading of extremely overbought proportions. And you might say, well, does that mean that the market's going down? Well, what it does generally mean when you get into these overbought extreme cases is that markets can dip a little bit or at least stay sideways. So they might grow, and of course the trend will generally be bullish overall. So this is not a bearish signal for markets that it's all going to collapse and crash straight away. But when you get into these points, you might notice some of these dates. Just after, of course, the election last year, we saw a lot of markets hit euphoria. Then, of course, we saw them hit it again. Then we got a pretty significant pullback. So are we in extreme overbought? The answer is quite simply yes. We know that already. But where is the trigger? Could it be coming very soon? Well, we kind of feel like it could be October, and we'll talk about that soon. But have a look here. Even the Barclays Euphoria Index, that's in super overbought as well. And I always say on this channel, it's patience, react, don't predict. The current trend, as we've been seeing, is bullish, 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 bullish. There's not much you can do. But you'll notice here that David Keller has actually gone through and he's done the advanced decline line, which we love on the channel. Of course, we do it for the S&P every day. Make sure to sub for that as well, because it's good little indicator there. And you can see here that it turns out that if you actually look at the New York Stock Exchange, large caps, mid caps, and small caps, the advanced decline line actually has been going down a little bit in more recent times. Now, we're not seeing this in defensive sector rotation, so it doesn't suggest necessarily that there's it's absolutely a defensive move. But still, this is not exactly the normal thing that you would see while you're ramping in the market without a pullback. So what other things are we seeing? Well, one of the big ones is that everyone wants to still be in the US market. You can see here that people want the US market from overseas, but they're not doing it by buying US dollars. Or if they are, they're basically hedging it instantly. So the ability or the amount of people hedging US dollars has just gone parabolic. Everyone's hedging compared to where they were last year. And you'll notice that kind of coincides a lot with Liberation Day. And of course, this is the current trend. But what we did see over the last 24 hours is that the dollar index went down to support and then kind of started to pick back up off that level. And we'll talk more about that soon. The other thing is, will we still see a buy the rumor, sell the fact, or is this just going to keep ramping up? The first day, you'd have to say it was a buy the rumor, sell the talk, then buy the talk, because that's actually how the market moved. But we'll find out probably by the end of this week. Remember, there is a lot of options to expire, and we are currently in positive gamma. So there's a lot of money to be made by the street, especially over the next session or two. So it's also about the structure at which the markets go. If we end up rallying over the next couple of months and we end up creating a nice 1 to 3 month gain, then it's unlikely we're heading for recession anytime soon. It also will matter what types of sectors come with that. So remember to pay attention. We'll be looking at structure, and we'll be paying attention particularly at, of course, margins. Because if margins start to decline again, that could be another early warning sign, along with the construction, which is a very early indicator usually. And this all tells us that maybe even the Fed won't be able to hold it up. So there's a lot of things here playing out. And of course, it'll be about discerning which ones matter and which ones don't. Another thing that we have been mentioning is that it's unlikely, based on the first couple of days of trading of September, that we were going to see an epic sell in September. And the main reason that was because when we look at the stats here from August and July and those kind of periods, or June, we actually end up with October being the more volatile time. Thanks to Wayne Whaley's study here, great guy, definitely want to check him out. He has here quite a lot of great stats that show you that only 6 similar Octobers were up and 18 were down. So again, do we expect volatility to continue in markets? Yes, we do. Let's now have a look at the charts and see how it all played out. So the advanced decline line, I think for the S&P, it's looking okay in my opinion. Again, there is no price action telling us to short the markets. And you can also see here that the markets went down through the session and then they instantly got bought back up. Now, I was hoping for a 65.20. We talked about that in the previous video. It didn't want to go down that low. Somebody just went, yeah, let's buy that up. And they certainly did. Is this a warning area though? Well, I would say generally it is. But if we take a new high, that usually means more gains to come, at least in the short term. And that's what I'm looking at over the next 24 hours, 66.36. Because if that level gets closed above, it suggests there's quite a few good positive sessions to come and that we may push quite a lot higher, maybe triggering a 67, even possibly a 68 before anything really goes bad. These levels are super solid overboughts, but at the same time, when levels are taken and closed above, you know that is a squeeze style situation. And you'll see here, this is the level that we were hoping to get over the last 24 hours to see bid buyers, but it went down and it pretty much hit around the options level low. So it was a pretty tough one to get unless you were on the smaller time frames, but that is how the market has been a little bit recently. Let's have a look at why all of this was. Well, everyone tried to short. I don't know why it is. Every time anyone wants to go a bit negative on the economy, no. Too many people jumping on the puts again. 6,600 puts all over the place. Obviously, we are pushing higher. 6,700 becomes the next target for the options on the call side. And you can see here that once we get through the next 24 hours, which is pretty wild, certainly a lot of puts and a lot of calls floating on there, then 66 continues to be that positive gamma style situation into the OPEX. So there's a lot going on here. I expect the next 24 hours to continue volatility. And if you had to guess, a lot of the time, the Thursday is more bearish, but who knows? I mean, the price action's coming in super bullish right now, so you wouldn't really be thinking that this time around. Now, what about Tesla? Well, it continues to be in positive gamma, 425 plus close, suggesting there's more buying on the way. And of course, we talked about 450. Nvidia still stuck. It's looking a little bit more like it's back in its sideways action. But if it ever does get through 185, that's going to be a huge sign for Nvidia in terms of the rallies. And when we're looking at, of course, what we've been talking about on Bitcoin, it still looks pretty strong. Now, there was actually, I still don't really know if this is real or not, but there was that Trump Bitcoin statue supposedly erected outside the White House or something. And well, either way, Bitcoin's, of course, in the news a lot this year. And we know here that it is in positive gamma. So again, that strengthens the case for the crypto market at this stage. And gold struggling with the 340. As we mentioned over the last 24 hours, there was a lot of resistance being hit, and gold was, of course, at the forefront of that. All right, let's jump into the charts now and have a look at the yields. Yields went down, yields went up, yields kind of stayed the same. So no break underneath the important 3.4. And even though I think the dot plot kind of points, in my opinion, to way more cuts next year, especially if the things play out, the market's not quite pricing that in. And that's because, of course, Jerome Powell said, this is unusual. We're seeing inflation kind of doing this a little bit here, so that's a problem, yeah? And then we're going to have to cut rates because the jobs numbers, they're just bad. I mean, basically, they just said it's bad. Not so good, kind of bad. We're going to have to do this. In terms of consumer discretionary versus staple, it's still strong, which means, of course, buyers are still around. And you can see here, RK got a close above the previous high. So what this has done is it's solidified that there are buyers here in RK. Now, of course, there's always a chance this is a false break. There always is a chance of anything. But at this stage, again, I'd be just going, this is looking momentum-like. The markets are, of course, pushing higher in futures, and that seems to be kind of the way it's looked at. IWM was doing really well versus the NASDAQ, and then it got crushed back down. But I think the Russell, of course, was a bit of a beneficiary of rate cuts and more expected, and Treasuries held around 90. But I'd still expect the potential for 92, 93, and maybe Treasuries have started their move slowly towards 100 over the next coming months and possibly even more. Currencies, you can see here, the Aussie even fell off. The Euro, of course, fell off as the dollar strengthened. But the other story was gold. Hit 3,700. Very nice, which was, of course, our first target. And then it pulled back a bit. I think there's going to be a big move on gold down at one point soon. And it's not saying I'm bearish on it. You know I'm bullish. But that RSI read we got the other day, it makes me want to, leave a little bit of powder dry for the old gold, yeah? But ultimately, we're still thinking 4,000, 4,200. And silver, of course, dropping here a little bit. Again, getting an unwind thanks to that dollar strength, at least temporarily. When we have a look at oil, it came back down to support. It's holding that level okay. So, of course, this is a zone we'll be watching very, very closely on oil. And semiconductors came down to the first level of support, that role reversal, and then they were bought back up. There's a lot of overbought reads here in these markets, but again, we don't have those triggers yet. Tesla ended up closing at a new high, suggesting, of course, positive gamma. Again, it's in an overbought read. There's overbought reads everywhere, but that just means that maybe it's good to have powder dry. You probably don't want to buy here. Some of you may want to, but up to you. And we're seeing this across the board, even in Chinese stocks. Have a look here at Baba. It's going ballistic. I mean, people have gone ballistic on some of these Chinese stocks. I mean, look at Baidu. How do I spell Baidu? Let's see. B-I. Oh, we'll just use this one. So you can see, look at this. 11.33%. Just a week ago, we were talking about this in our private community. The thing's gone up 39%. So that's what I say about China. When they go, wow, it is like the rocket ship to the moon. This thing is, it's like a penny stock, but it's not actually a penny stock. And you can see here again, we get an overbought signals on many different markets around the world, but they're all still in an upward trend. So you cannot say that it is time to go. Now, what about the US 2K? Well, it hit our first major target. So I'll give you guys a clap for that if you held in. Well done to you. And again, it's not really giving us a sell signal. If we were seeing sell signals, we'd be underneath 2370 kind of area, underneath the daily 20, those types of things. And NASDAQ just closed a new high. So it's still up, still bullish, still doing its thing. It's loving the sugar rush for now. And of course, it's all about the sugar rush. And even in the cryptoverse, as we've been bullish here on Bitcoin, we didn't get no 111, 110 kind of prices like I would have preferred to get a little bit more buying in. But anyway, it is what it is. And the market is pushing higher off the back of that positive gamma in the options world with Wall Street. And of course, just in general, I don't know, maybe it's a statue thing. But certainly across the board, generally speaking, markets are a bit risk on. So markets are up here, guys, but there are weird signs starting to show up, at least for the temporary potential here of a volatile period. We are going into OPEX. You guys know where the markets are at this stage, and I'll be looking for a close above the S&P high of the last 48 hours. If that does happen, well, I think it's like 2-3 sessions. If that does happen, it suggests there's more squeeze to come. And for now, yeah, we don't have any signs of decline. So, of course, just remember, there's always opportunity, there's always abundance, and you do not want to be FOMOing into anything. Always about replication when it comes to trading and investing. And that's something that I've really learned very hard lessons on earlier in my career back in 2007, 2008, 2009. But at the same time, it's stuck with me forever. So don't be a dum-dum. Always remember, when you learn a lesson, try to implement it. And of course, don't make that mistake twice. Make sure to sub to the channel if you're interested in finding out more. Follow us over on X, follow us on LinkedIn. And then, of course, check out our courses if you're interested in more details about how we find some of these things. And as I mentioned, at the moment, the Federal Reserve is concerned. You can clearly tell. But at the same time, they've got a dual mandate, but the mandate went to jobs, 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 jobs. And for now, the sugar rush has continued. We'll see you in the next video. Bye for now, guys.